Hello everyone, my name is Jean Pyle and welcome to my YouTube channel. For those of you who are new, my channel's objective is to give business spirituality information. I have provided a link to a video that explains what business spirituality is in the description below. So if you are an owner of the company, an employee, an investor, a stockholder, or a job seeker, then you must have awareness, knowledge about this one thing. The financial reports. It consists of the balance sheet, also called the statement of financial position, the income statement, also known as the statement of comprehensive income, and the statement of cash flows. The information that you'll get from understanding these three reports will give you clarification on any questions that you may have on the business, such as, is the business profitable? What is their main income from? How is the company funded? Is this company prone to recession? Does the business demonstrate agility and resilience in difficult environments, such as this pandemic?
What is the three most important financial reports? These are called balance sheet, income statement, and statement of cash flow. The balance sheet, or statement of financial position, summarizes a company's assets, liabilities, and capital, our shareholders' equity, at a specific point in time. It goes to this equation: asset equal to liabilities plus capital. As per IFRS 3, business combinations, to be considered a business, an integrated set of activities and assets, must include, at a minimum, an input and a substantive process that together significantly contribute to the ability to create output. The input, in this phrase, is the asset. The asset has the ability to create output, which turns out to be your revenue. Assets can be in the form of cash, inventory, properties, etc. The balance sheet shows the total assets of the business, and how much of the asset were funded by the bank, by other parties, and by the owner of the company, the shareholders, including the business operation. Example, you sell inventory, which form part of the assets. The question now: where did you get the funding to buy these inventory? If by the end of the financial year you haven't paid your supplier, then it becomes a liability, because you need to pay for it. Else we may say it's funded by the company from its operation. What is the importance of balance sheet? Again, balance sheet tells you how much the company owns, called assets, how much it owes to other parties, called liabilities, and the equity of the company, which composed of 1. How much did the owner invested in the company, which is known as capital, or shareholders, and 2. The cumulative earning of the business, also known as retained earnings. What is income statement? Income statement shows the financial performance over specific accounting period. It goes to this equation: net income is equal to total revenue plus gains on non-operational activity, plus other income, minus direct expenses, and general and administrative expenses, including losses on non-operational activity, and other losses. This is the main components of an income statement. Operating revenue are revenues coming from the core, or primary operation, of the business, whether it is retail, service, manufacturing, production, distribution, etc. Non-operating revenue are revenues coming from non-core activities of the business. Example, if your core business is retail business, yet you have an extra space in your warehouse, and you rent out the space, then the revenue coming from the rent is a non-operating revenue. Other income, or loss, are netted value of income from one-time activities of the business. Example, selling the delivery van, or other assets of the business. It would be good to know that revenue is not the receipt of cash. However, it should be earned at the time of income statement generation. Example, an 18 months contract to provide services, beginning the 1st of January of the current year. would only generate 12 months of revenue by the 31st of December of the current year, assuming that you have provided all the services for 12 months. Direct expenses are expenses directly related to the product or services sold. This is also called the cost of goods sold. Example: direct material, direct labor, depreciation cost of equipment used in production, utilizes for production, and shipping cost. Operating expenses are incurred for generating the normal operating revenue associated to the core activity of the business. Example: selling and marketing, general and administrative expenses, depreciation or amortization, and research and development. Typical items that make up the list are employee wages, sales commissions, marketing expenses, and utilities. Non-operating expenses are incurred for non-operating activities. Example: interest on loans. Other expenses are incurred for the one-time activity or any other unusual costs or expenses. What is the importance of income statement? It shows the performance of the business. Most importantly, it shows the core or the main income generating activities of the business. It answers the questions of: can the business survive from its own operation? Where are the bottlenecks? If you have read The Rich Dad, Poor Dad, it discussed about assets which are liabilities. It says that, if the asset bought can give you revenue more than its appropriated cost, then it is an asset. Else it is a liability. Simply, if the asset that you bought is depreciated at $1,000 annually, and it generate $1,500 annual revenue, while the associated expenses for this property is $200 for taxes, service charges, etc., then you have $300 net income. This is an asset. However, if it only generate $1,100, then it's a liability because you lose $100 annually from this asset, although it is categorized as asset in your balance sheet. The non-operating and other income or loss activities of the company shows the strategic management of the business. Example: if there are rental income coming from non-operating income, it gives you an information that the company is looking for other ways to create income. The next thing for you to inquire is: how did they fund the property bought? What was the intention of buying the property? Is it originally intended for operation or investment? What is statement of cash flows? Statement of cash flows provides information on all the cash inflows and outflows from the company operating activities, the core of the business, investing activities, and financing activities. A company can use cash method or accrual method accounting. This should be established from the first year of operation of the company. Most companies, especially public companies, follows the accrual method accounting. While the income statement shows revenue earned, whether or not cash was received, the statement of cash flows will give you information on how much cash was received from the revenue or financing.
The cash flow is broken down into three categories: cash flows from operations, cash flows from investing, and cash flows from financing. Cash flows from operations includes transactions from all operational business activities. This starts from net income. Then add all non-cash expenses and changes in working capital. Non-cash expenses are expenses where there were no outflow of cash, such as depreciation. Changes in working capital means to deduct all revenue for the year in accounts receivable section, and add all expenses for the year which haven't been paid yet or in the liability section. This will provide the information on how much cash was received and spent for the year from operation. Cash flows from investing includes cash inflow and outflow as a result of investment gains and losses. This section shows the cash spent on capital expenditures or CapEx, and payment received from selling capital assets such as property, plant, and equipment. Cash flows from financing includes the cash flow between the company and its owners and its creditors. Cash obtained or paid back from capital or owners, and liabilities or creditors for loan are shown here. Example: the paid out dividends, or share buybacks, and loans incurred or paid back. What is the importance of statement of cash flows? Statement of cash flows gives information on how the company manages their cash flow, how much cash is generated from its operation. It also shows if the company are paying for inventories, salaries, utilities, etc. It also provide you with the investment capabilities and strategy of the company, and if the company is paying dividends and their debts or taking more debts.
The financial reports can provide you with many information depending on what information you are looking for. This gives you a basis where to start due diligence. If you are an investor, you would like to know if the company is of going concern, meaning it won't be filing bankruptcy soon. If you are an employee, you would want to know where you can add value, or if you still want to continue with the company. The information provided by the financial reports can be collaborated with other information. We will dig deeper on these financial reports on the second and third part of Financial Reports video series. Click like and subscribe for you not to miss out on my new videos. I appreciate also if you can share this to your family and friends. Thank you very much.